Hello, welcome to the Money Bites podcast, where we talk about crypto, personal finance, and everything in between. My name is Lulu, and today we'll be talking about stablecoins. What are they? How do they make the financial system better? And how can you take advantage of them? If you're joining us for the first time, please remember to like, subscribe, and share with your friends. Let's go. So, it's time to tell ourselves the truth. Cryptocurrencies have a major flaw. Right. I mean, everybody thinks cryptocurrency is the future. I still actually really believe cryptocurrencies are the future, but cryptocurrencies have a major flaw, and that flaw is volatility. Since the cryptocurrency industry kickstarted following the aftermath of the 2008 financial crisis, right, the industry has grown to about a $3 trillion industry, and Bitcoin represents over 30% of that industry. So, yeah, everything looks good. But the major flaw with cryptocurrencies is volatility. Crypto volatility makes it extremely difficult for people to use it for common use cases like lending and buying goods and paying for services, right? Because imagine you have, say, one Bitcoin today, and you need to pay for maybe your dry cleaning, or maybe you need to pay for maybe some goods that you bought at the supermarket, right? The volatility of crypto basically means that the price keeps going up or it keeps going down. The price is not stable. So if you're a business and you accept payments in crypto, it could mean that if you set a price for a particular good or for a particular service, it could mean that in the future, the price you set for that service, because of the price volatility of cryptocurrencies, might not be enough to cover the cost basis of that service. So this is the major problem and the major pitfall that cryptocurrencies face when it comes to user adoption on the larger scale. But what if there is another option? And that is where stablecoins come in. Stablecoins are a new form of cryptocurrencies, right? It's actually a growing cryptocurrency market that started about 3 years ago with platforms like MakerDAO, like platforms like Theta, like USDC. And the difference between a stablecoin and a cryptocurrency is that a stablecoin is backed by a real world asset. So that real world asset could be commodities, it could be actual fiat currency, and it could be even other forms of cryptocurrencies, right? So what makes a stablecoin different from other forms of cryptocurrencies? One, you can't really trade a stablecoin because the price is meant to be stable. The price isn't volatile. It doesn't change, so you can't trade it. It's possible that the price for a stablecoin can change, but that rate of change is very very little, very very minute. So maybe for instance, USDT is pegged to the price of the dollar, right? So what that means is that one USDT is redeemable for one US dollar. So of course, there could be a plus or minus difference between the prices. So sometimes one USDT could trade for $0.99, and sometimes you could trade for $1.0, but it's never more than plus or minus 1 cent to the price of the dollar, right? So also another difference between a stablecoin and a cryptocurrency is stablecoins are similar to fiat currencies in the form and other assets like precious metals, because the price isn't volatile really. So you can easily use them for monetary transactions. You can easily use them to pay for goods and services. Stablecoins also have assets backing. That is, for you to be able to issue a stablecoin as an issuer, maybe you're a company like okay, let's say you're a company like Circle or Theta and you want to release a stable coin, right? You need to have, let's say you want to release a stable coin of say $1 billion. You need to have $1 billion of real world assets. So if you're a stable coin that is backed with maybe precious metals like gold, right? It means you need to have $1 billion of worth of gold in a vault somewhere. So it allows you to be able to issue stable coins that are backed by that commodity, which is gold. Or maybe you are backed by a fiat currency like maybe US dollar or maybe British pounds or even e-naira like Nigeria's stable coin. It means that you need to have an equivalent amount of real world assets. It could be money, it could be fiat money, it could be commodities in a vault somewhere that is tied to the value of stable coins that you want to release into the market. So that gives us an understanding of the difference between a stable coin and a normal cryptocurrency like Bitcoin, Ethereum, Solana, and all the other cryptocurrencies you have there. Let's talk about the different types of stablecoins. So you actually have four major different types of stablecoins. You have fiat-backed stablecoins, you have crypto-backed stablecoins, you have commodity-backed stablecoins, and then you have algorithmic-backed stablecoins or algorithmic stablecoins. So a fiat-backed stablecoin is very simple. It just means a stablecoin that is backed with fiat money. USDT is an example of a fiat-backed stablecoin. E-Naira is an example of a fiat-backed stablecoin. Also, sorry, I forgot to mention there is also one other type of stablecoin, which is called the central bank digital currency. The e-naira is actually an example of a central bank backed digital currency, right? So a fiat backed currency is basically a, a stable coin that is pegged to the value of a fiat currency. So an example is the USDT, popularly called USD Theta, and also the USDC, which is pegged to the value of the dollar. So one USDT is equals to $1. So, like I explained earlier on, if if you're a company like USDT now, you're a company and you want to release your own stablecoin, it means if you're going to release $1 of a stablecoin, it means you actually have $1 in a bank account or in a vault or in a custody of another finance company or another asset management company. So that's how a fiat backed stablecoin works. So you also have something like a crypto backed stablecoin. So without getting too technical, a crypto backed stablecoin is basically a stablecoin that is backed by the value of another cryptocurrency. An example of that kind of a stablecoin is something like wrapped BTC, right? Wrapped BTC is not exactly a stablecoin, but it's actually a form of cryptocurrency that is tied to the value of Bitcoin. So the value of wrapped BTC is always going to be equal to the value of Bitcoin. There are a variety of crypto-backed stablecoins. You have wrapped ETH, you have MakerDAO, a whole lot of them. You have DAI as well. So all of this forms different types of cryptocurrencies backed stablecoins. You also have the commodity backed stablecoin. So this is a stablecoin that is backed by a real world asset, a real world commodities, like maybe gold, for instance, right? You have Tether Gold, which is a very popular one, and a whole lot of other ones as well. The third type of stablecoin is an algorithmic stablecoin, right? An algorithmic stablecoin is a stablecoin that is not backed by any form of real world assets or commodities, right? So unlike the fiat backed stablecoin or the crypto backed stablecoin that is backed with maybe fiat money or an asset like gold or maybe a cryptocurrency like Bitcoin, an algorithmic stablecoin isn't backed by any form of real world assets, but it's a stablecoin that uses an algorithm or code to modulate the supply of the stablecoin in the market based on demand. So basically, what this means is that there is an algorithm that modulates the supply of that stablecoin in the market. So if there's too much of that stablecoin in the market, the algorithm automatically burns a part of that stablecoin. So what that means is that it takes a part of that stablecoin out of circulation. And then if there's too little of that stablecoin and there's a lot of demand for it, it mints a new set of stablecoins, right? And adds it to the money supply. So it's kind of like how you have the normal market functioning, right? So the central bank can decide to increase or decrease money supply depending on certain monetary policies. But unlike how you have it with central banks, algorithmic stablecoins are based on market demand, really. So that's the third type of stablecoin. And then you have the final type of stablecoin, which is the central bank digital currency. So a central bank digital currency is basically a stablecoin that is tied to the value of a particular country's fiat currency. So in Nigeria, a popular one is the e-naira, which is tied to the value of the naira. So one e-naira is equals to one naira, basically. And the central bank digital currency forms part of the total money supply in a country. So what central banks use the central bank digital currencies for is to actually push forward financial inclusion. So what that means is that there are a lot of people that maybe do not have access to bank accounts and all of that. So they can use the central bank digital currency to bridge that gap, right? So I mean, it can also reduce costs for cross-border payments amongst other things. So we talk about how stablecoins can improve the financial system. So there are four major ways that stablecoins can improve the current financial system. One of it is remittances, privacy, um, payments, and financial inclusion. So when you talk about remittances, basically remittances is when you have a relative abroad and then your relative wants to send money to you in Nigeria, or maybe your relative wants to send money to someone in Ghana or whatever country that you live in. So stablecoins actually make it easier for you to actually do those kind of transactions, because what it means is that, for instance, you don't need to use Western Union or other remittance platforms to be able to do that. Also, you don't need to open an account, a bank account that supports the kind of currency that you're trying to receive from a partner. Also, beyond remittances, stablecoin can also help you to facilitate cross-border payments. So, for instance, you're a business owner, you live in Ghana, and say you sell maybe kente clothes online, and you don't want to only sell to your Ghanaian customers. You want to sell globally. You can put your prices in stable coins, and then you start receiving payments immediately. Actually, this is one of the products that we actually offer at Quiver Finance as well. So what that means is that you can create an online store, right? Put your goods online, and then you start receiving payments in maybe USDT or any other stable coin that you like. So it automatically gives you access to a broader market, right? Rather than waiting for your fellow Ghanaians or your fellow Nigerians to patronize you, you have a global market that can actually buy your goods, and you can support them. So naturally, if you wanted to do your business in this kind of way, it means that you needed to first of all open a dollar bank account or a euro bank account to receive those payments. And it's usually not very easy to get those accounts open because of statutory KYC requirements, right? So a lot of people do not have the required documentation to open these accounts, So it really, really stifles your access to the global market, basically. So this is one of the things that stablecoins can do for you. The other thing is privacy, right? So we talked about the requirements for opening a normal domiciliary account, right? If you want to open a domiciliary account in Nigeria, you need to bring two references of people in a particular bank that you want to use that already have a domiciliary account. You need to bring your address, your identity documentation, and all of that. Of course, these KYC requirements are very important because they're used for preventing money laundering and facilitating other forms of criminal activities, right? But for most people find it difficult to present this documentation because, I mean, a lot of people don't have driving licenses, a lot of people don't have any valid identification. So obviously they are automatically excluded from the financial industry, right? I mean, from financial services that can actually boost their businesses or even make their lives better. So this makes it very, very difficult for them to take advantage of global markets and take advantage of financial systems that can actually change their economic reality. So stablecoins actually help you to bridge that gap. Also, remember in the last episode we talked about cypherpunks, and basically the belief of cypherpunks is that people should be able to make transactions online and also keep their privacy. Nobody needs to know who you are when you're trying to make a transaction. Nobody needs to know how much you have in your bank account because you're trying to do an online transaction. Nobody needs to know where you live or what you look like. I mean, people should at least have their human dignity and their privacy, right, when transacting online. And that's what privacy is all about. And stablecoins allow you to achieve that. So in essence, I already talked about financial inclusion and payments in the two sections I already talked about. So I don't think we need to go over that again. But the idea is that stablecoins allow you to connect the unbanked and underbanked part of the of the society to the financial system. I already talked about CBN releasing the e-naira, right? And the rationale behind releasing the e-naira is actually to onboard more people into the financial system, right? Nigeria as a whole has over 40% of its population, adult population really, not having access to financial services. And what that means is that you don't have access to loans, you don't have access to savings, you don't have access to sophisticated financial services that allows you to actually, change your life basically. So stablecoins actually bridge that gap and allow you to solve those problems. So obviously, we've been talking about how good stablecoins are. Obviously, there has to be some risk with it, right? I mean, there has to be some cons, right? When you talk about stablecoins, right? All cryptocurrencies really have risk. Even Bitcoin, Ethereum, and all other, even non-stable cryptocurrencies have risk. But stablecoins have peculiar risk, intrinsic risk that are attached to them. So one of those risks is the stablecoin itself losing its peg. So when you say a stablecoin loses its peg, it means that the stablecoin is no longer equal to the real world assets that it is backed by. So remember, I said, for instance, you have a fiat backed stablecoin now, like the USDT. If the USDT is no longer equal, if one USDT is no longer equal to $1, it means that the USDT has lost its peg. So we'll talk about the stablecoin that lost its peg in subsequently. One of the other issues that one of the other risks you could face with the stablecoin is market interest. So if, for instance, you have a stablecoin that there is no market interest for it, right? Nobody is interested in using it. Obviously, that stablecoin, if you use that stablecoin on a blockchain where, there's no market for it, and you have invested your money, maybe you have $1,000 worth of that stablecoin in a platform that nobody uses, it means that you will not have liquidity to be able to take that money out of that platform because there is no market demand for it. So that's another risk of stablecoins. Then the third one is the risk attached with algorithmic stablecoins, right? So a very high profile case of such happened recently with the UST stablecoin. The UST stablecoin is an algorithmic stablecoin that is tied to the value of Luna, which is the native coin of its ecosystem, right? So what that means is that the market supply of the UST stablecoin is determined by minting new UST or burning Luna. So what that means is that if, for instance, you need to increase the market supply of UST, that means that you need to burn $1 worth of Luna. And then if you need to decrease the market supply of UST, that means you need to mint $1 worth of Luna and vice versa. So that's how the UST stablecoin works. So when the UST stablecoin depegged, meaning it lost its peg, it was because the value of Luna could no longer match the value of UST that was already in the market supply. So there was no way that the UST could maintain its peg, and then it lost its peg. This caused almost a wipeout of over $40 billion in the cryptocurrency market, right? A lot of people lost a lot of money. A lot of people who had bought UST had to sell it off for pennies on the dollar. Stablecoins are actually risky, right? But the only way to make sure that you avoid this risk is to study how the stablecoin is backed and what regulatory compliance the issuer of the stablecoin follows, right? So in conclusion, stablecoins have actually come to stay, right? We cannot really have an ecosystem, a cryptocurrency ecosystem without stablecoins because people need to make payments. And with volatility of other cryptocurrency assets, it makes it very, very difficult for people to rely on those assets to make payments or to use them as a store of value. So stablecoins are very, very necessary. And then, like I said, they also bridge the financial inclusion gap for most people. So with all this risk and all these benefits of stablecoins, it means that people need to actually do a lot of research before you pick a stablecoin that you can put your trust in and put your money on and use it to facilitate your transaction. So currently on Quiver, we support a variety of stablecoins, and you can pick your choice out of them. So, but the most important thing is do your own research and choose the best one that works for you. This episode of the Money Bites podcast was brought to you by Quiver Finance Inc. Follow us to learn more about how to do more with less. Thank you.